Even though I don't like rattlesnakes, I'm fascinated by this company called Diamondback Energy. It's a classic startup. It's a young company, only about 10 years old. We've talked about the fact that the Permian Basin is where it's at right now in the shale plays in the United States, and you can see that's where they're focused. The initial public offering, if you will, in 2012, this is where they transitioned from being a private company to a public company. What does that mean in practice? It means that the company is publicly listed on an exchange. I believe they're listed on the Nasdaq, and suddenly the stock becomes publicly traded. So what they did was they offered a number of shares out to the public market. Those were sold, and then those shares, that's a part of the daily trading that goes on any stock exchange. They have almost 200,000 acres. You see where they are, where they fall on the little graphic. This graphic is from an investor update in September 17th to Diamondback put onto their website. And that points to one of the disadvantages, if you will, of being a publicly traded company is you have to make more information publicly available. But it's great for researchers like me and teachers like me because it gives us lots of information that we can show you. I've actually put that investor presentation on the website in D2L with these deck of slides, and I strongly encourage you to look through that. Time permitting, we're actually going to flip through it some in class. I'll be honest with you, I don't understand 100% of the terms in the slide deck. It could be some company specific terms. I've looked through a lot of different sites to try to sort it out. But I think you're going to get most of it, and you're going to see how they position themselves, which is that they have really good acreage in terms of the quality of their holdings, and that they're excellent at producing the oil and gas in a very cost-effective manner. Sounds like a pretty interesting company. Well, let's look at the financials. You see a little bit backwards of how we read things, 14, 15, 16. And you can see instantly, this is out of another document posted to D2L. This is their 2016 annual report. And it's a part of their 10K filing, which is a publicly traded company required to do. You can see that their reserves have grown significantly across the board. They closed on another acquisition in 2017 that also grew their reserves just from the acquisition standpoint. The increases could simply reflect that they've had increased drilling activity across these years. Remember, to prove a reserve, you have to drill it. And so this may simply be a byproduct of that increased drilling activity. But you can see that they have consistently grown. Notice we have the estimated proved developed and proved undeveloped. And this would be where they feel like they have very, very good understanding of the wells that could be located next to their producing wells. And then you see this is what they think they could do. This is simply combining the two. I cut the slide off, but they also have more data down here about some of the other well opportunities. Well, what's that look like financially? This is where the picture begins to get complicated, and this is why you're going to be interested in taking Dr. Forster's and the combination Dr. Young, Dr. Tilker class. You can see that although revenues were up significantly in 2016, that they lost a lot of money in theory and income. They lost $68 million. In 2015, they lost $750 million after having made almost $250 million in 2014. But then you get into this little line right here that's called impairment, and the write-downs associated with impairment. I'm going to let that be a teaser for Dr. Young. He is an accounting guy. He's going to have to explain that in a lot more detail. I'm going to tell you about what I understand about impairment. This is where they're having to write down the value of their reserves. So you see they took a huge hit in 2015, and that write-down was due to the price drop in oil that occurred in 2015. But I want to show you something else about this. See, again, so you've come down here after you do all these adjustments, they're still saying that they lost money, and not an insignificant sum of money. You're going to see it doesn't look quite the same of that when we look at their financial or other aspects of their financials. Onto the balance sheet. Again, 12, 13, 14, 15, 16. Some things I want you to see. I want you to see that they have consistently grown their total assets. And a lot of that is because they've been out on an acquisition spree and they've been out on a drilling spree, and they just bring up the value of their property and equipment. But notice what they've had to do to make that possible. We talk about debt versus equity. Well, here's their long-term debt, which in 2012 was pretty small, steps up immediately the first full year they're public, to $500 million, and now they're all the way up to almost $1 billion in debt. Equity-wise, again, you see an explosion in 2016. This is because they went to the public markets and issued more stock as a way of raising money. The impact of that was actually a little bit surprising, and we're going to look at that in just a minute. Impairment is not a cash activity, going back to the income statement. Because of that, you're going to see that in terms of the cash provided by the operating activities, they were always making money throughout all these years on a operating activity standpoint. However, investing activities, this in part is the retirement of debt and some other things, they used up a lot of money to retire debt, and they had to raise a lot of money through equity sales. But notice the change in cash, it jumps way up in 2016. But in 2015, after showing that huge paper loss, their actual change in cash only went down $10 million. Why the 1.6 billion in cash at the end of 2016? That's because earlier that month they announced a deal to buy the properties of a company called Brigham, which had Permian Basin properties, that was expected to close in early 2017. So they issued stock in 2016, in December 2016, to get ready to pay that bill. I'm going to, let me check to make sure. Yep. I'm going to pause the slide because I'm going to bring in a different material for us to look at. Okay, I've switched to a Yahoo Finance stock trace. Got 3 lines on this chart. The beautiful purple line is Diamondback Energy. The less than beautiful pink line is a comparable company called Apache. And the blue line is the NASDAQ. It's always good to put comparison traces on stock charts because that may be key to understanding what's happening. What I wanted to cue on are the 3 stock issuances for Diamondback. The first was in January 2016, so right in this time frame where my cursor is. And it's probably right about here, and I'll tell you why in just a second, when they sold 4.6 million shares of stock, which included some warrants for the underwriting firm. And notice the price that day. It closed at $75, opened at 64, and closed at 75. The stock price that they sold their stock at was at $55, and I don't have the exact date in January that it happened, but you can see if it was down here, not too bad. It closed at 66. If they sold it right here, not bad at all. It was at 50, or they did at 55, and there they would have paid around 60. What surprises me, and this is a good thing, is see how the stock price continued to rise even after the issuance of the stock? That's good, because a lot of times that would be considered a dilutive event. And if you're not familiar with stock dilution, that's something you're going to want to go Google. And the fact that they didn't seem to pay a price for that is really quite good. We see that Apache and Diamondback are moving in relative parallel motions here. And this is interesting because notice Apache takes quite the dive in July. Well, guess what? Diamondback did a second stock issuance, this time of over 6 million additional shares at a price of $87. And again, you can see why that makes sense, because if you look over into this part of the chart, see that for most of July, that was well above, their stock price was above that. And that's common, that you're going to have to issue to sell the shares at a discount to what they're being publicly traded at. The last one came in December, when Diamondback was raising money for the purchase of Brigham, And again, they sold this time 12 million shares, or more than what the other two share sales during the course of the year were combined. And what's interesting is they really don't seem to pay a price on their stock price. The stock market was, what that says is they really think that it was going to be a good acquisition of Brigham, and therefore raising the money to do the purchase was not a problem. And it's interesting because Apache is on a real decline here in the first 3 months of the year, whereas Diamondback is relatively stable. So these are the three stock issuances, and that's how they raised that $billion+ Again, if well, it's too hard for me to go back to the other slide. Go back to the other slide, you would see that's how they did it, is with those stock issuances. The other thing I wanted to show you here is who owns Diamondback stock. Well, you can see that these are the direct holders, and these typically are individuals that are associated with the company. And you can see that less than 0.5% are held by insiders. How you have more than 100% being owned, I don't know. That's something you finance gurus could explain to me. But you can see that the largest holders are some of the big banks and some of the big mutual fund groups. And what's interesting, if I go down to the mutual fund holders, this is one that I personally own. So I learned preparing for this that I own a part of Diamondback Energy. So now you've got full disclosure on my part, not telling you to go buy the stock. So you see who tends to hold these sorts of stocks. A lot of the stock is in fact held by these institutions that do investing for other people. If you notice that you get to, I didn't add it up, but that's 20, 28, 34, 40, 46, 51, 54, 57, 60%, and now you're getting 60% of your stock is owned by companies that own 2%, 2.23% or more. And so there's a lot of people that own those last 1/3 of the stocks that are relatively small investors. So there's a look at Diamondback Energy. How did they raise money? They issued some bonds, and they're actually issuing and then repaying them, because at times when the business is in bad shape, what do you have to do? You have to offer them at a higher rate, and a bond is a form of debt. So that's why they were issuing and buying them back. As the company got into better positions, they felt like they could raise the money at a lower interest rate. But in the case of Diamondback, they also went out and did a lot of equity offerings, billions of dollars worth of equity offerings to bring in the cash they needed to fund the operations. Now we're going to jump into private firms and see how that looks significantly different.